Okay, so Chapter 22, S corporations, if you recall, this is an option in forming. You can choose to be an S corp instead of a C corp. You have to meet certain requirements, and you must affirmatively file the proper forms in order to be an S corp. And once you are, for the most part, you're taxed as a partnership, but it's not exactly the same. There's some important differences. So anyway, let's talk about how you become an S corp. Well, first thing you have to do is you have to become a corporation. And so the same rules about becoming a corporation for C Corp remain the same for S Corp. As far as the taxability of the transfer of property to the S Corp, which is not an S Corp automatically, we'll talk about that, but it's just a corporation, are the same. They're subject to Section 351 rules. So you got that control requirement and all that stuff. Although I don't think I mentioned it when we were talking about forming partnerships, note that there's no similar provision concerning control for the formation of partnerships. But here you have to meet the requirements of Section 351 for it to be strictly a non-taxable transaction. Not true for partnerships. As far as qualification requirements, you can only have certain types of shareholders. You can have individuals, but you cannot have as a shareholder partnership or a C Corp as a shareholder. On top of that, and also if it's an individual, they have to be either U.S. citizens or U.S. residents. Now, certain types of trusts can be, and estates can be shareholders, and there's some other things as well. Certain tax-exempt organizations can be shareholders, but we're not going to get into that deep detail. On top of that, and a big limitation for a lot of corporations is the number of shareholders that maximum shareholders that an S Corp can have. It's 100 shareholders is the maximum number of shareholders. And so that prevents such things as publicly held companies from being S Corps. Now, as far as the number is concerned, certain family members are included in that number. In other words, if you have certain family members who are shareholders and you own shares also, that's just counted as those family members, and you are counted as one shareholder. So you can have your parents, and it also includes not only family members but also their spouses. So you could have mom, dad, grandmother, grandfather, aunt, uncle, son, daughter, as well as yourself as a shareholder. That would be one shareholder. So that's to help out these family corporations, these closely held corporations owned by family members. As far as the limits on the corporate type, you can only be an S Corp if you are a U.S. corporation. In other words, foreign corporations, alien corporations cannot be S Corps. Also, you have to have one class of stock. Usually it's common stock. So if you have common and preferred, you would not qualify as an S Corp. Now you can have common and have voting rights on some and non-voting rights on another and still be an S Corp. That would still qualify. And so you become a corporation, and by default, if you do nothing else but become a corporation, then you are by default a C corporation. And so you have to affirmatively file a Form 2553 making the S Corp election, and you have to get permission of all shareholders. In other words, all shareholders at the time of the election have to agree and sign Form 2553 agreeing to being an S Corp. Now, as far as the effective date is concerned, the effective date would be whenever you want it to be, as long as, and certainly you can elect to be an S Corp in the future at some point. If you're a C Corp and you want to be an S Corp starting next year, you can do that. As a matter of fact, you could do that in the prior year, or you could do it in the year of the election up to the 15th day of the third month, so March 15. If you're a new corporation, you would want to make that election anytime within that 15th day of the third month of the current tax year. Now, it says on page 4 that even when the corporation makes the election on or before the 15th day of the third month, the election will not be effective until the subsequent year if the corporation did not meet the S Corp requirements for each day of the current tax year before it made the S election, or one or more shareholders who held the stock in the corporation during the current year and before the S Corp election was made did not consent to the election. So, just some exceptions there that could affect the effective date of when this corporation becomes an S Corp. So make sure you understand that. So we have an example here. Suppose CCS was formed by Nicole Johnson, Sarah Walker, and Chance Inc., a corporation owned by Chance Armstrong, as shareholders. Would CCS be eligible to elect S Corp status? What do you think? Well, the key here is you've got a corporation, and it doesn't really say, but I guess we have to assume that's a C corporation. And I guess it's in reading this requirements, this could be an S Corp. This Chan's Inc. could be an S Corp. So it's really the fact that you can't have any corporate shareholders. It doesn't matter whether that corporate shareholder is a C or an S corporation. So I stand corrected. So anyway, bottom line is CCS cannot elect S Corp status. Suppose Nicole, Sarah, and Chance recruited 97 U.S. residents to become shareholders of CCS. Meanwhile, Nicole gave several of her CCS shares to her grandfather and his bride as a wedding gift. After the transfer, CCS had 102 shareholders. Can CCS elect S Corp status? Well, here, that's when you get into qualified family members owning stock. It's treated as one shareholder. And so Nicole, her grandfather, and his bride would be considered one shareholder. So there would actually only be, what? $100 shares. So understand this, it's not less than 100 shareholders, it's no more than 100 shareholders. So it's a 100 shareholder limit. All right, so we just talked about how you become a corporation, S Corp. How do you terminate that S Corp status? Well, you can certainly voluntarily do it. Here, you don't have to, if you make a voluntary election to cease being an S Corp, you don't have to get all 100% shareholders to agree to it. You only have to have shareholders who hold greater than 50% of the stock. So it could be 51% of shareholders agreeing to terminate S Corp status. Same rules concerning the effective date of the termination. You can certainly agree to do it sometime in the future, but if you elect it in the current year, you have to elect it by the third day of the 15th, 15th day of the third month, excuse me. Now, invariably, what happens is not a voluntary termination, but an involuntary termination. You have, well, let's say you're a U.S. citizen shareholder of an S Corp and you sell your shares to a Canadian citizen who doesn't live in the U.S. That would automatically terminate the S Corp status as of the date of that transfer. And so if you fail to meet one of the S Corp requirements, that's an involuntary termination. And so sometimes, well, maybe many times, I really don't know. But think about this. Sometimes the S Corp may not even be aware that they have terminated their S Corp status. As a matter of fact, they may not find out until sometime later. Who knows? Maybe not even till several years later. So what happens then? Well, they have to go back and restate all of their prior tax returns from the time they had their S Corp election terminated all the way up till present time. So it could be kind of a headache. And remember, the thing about an S Corp, why do you want to do an S Corp? Well, you want to have the protections, legal protections of a C Corp, A Corp, corporation. But you want to be taxed as a flow-through entity, for the most part, as a partnership. And so, if there's a involuntary termination, and you've got to go back and restate S Corp returns to C Corp returns, well, what happens there? Well, think about that. You've got, for the most part, a non-paying tax entity who simply files their 1120S for reporting purposes, and of course has the K1 and sends K1s to, well, Schedule K, and sends the K1s to each shareholder. Items of income, separately stated items, and all that stuff still applies here. Some different rules, but still the same concept as partnership. So, all that has to be restated. And now, from the time the S Corp election is terminated, or status is terminated, they're a C Corp, they're a separate tax-paying entity. So it doesn't just affect the corporation, it affects the shareholders as well, because all of a sudden, for those tax years where the S Corp status was terminated, they have to restate their tax returns. This could be a huge mess. So this is of utmost importance. Which brings me to my next statement. If you're going to be an S Corp, you've got to have some pretty tight controls to make sure that you have the right types of shareholders, you have the right number of shareholders, et cetera, et cetera, et cetera. You've got to have somebody monitoring this stuff. And usually you're going to put some fairly restrictive transfer of stock rules in the agreement between the shareholders. Now we'll talk about this some. Oh, back to inadvertent or involuntary terminations. If the S Corp involuntary termination is inadvertent, it's some innocent mistake, the IRS, well, the corporation may ask for forgiveness, and the IRS may deem the termination inadvertent and allow the corporation to continue as an S corp, but the corporation has to ask for basically forgiveness from the IRS, has to prove that it's inadvertent, and they also have to prove that they took the steps to fix the problem within a relatively short amount of time. So there is that. How much that happens, who knows? Probably not a whole lot. Now, another way you can involuntarily terminate S corp status is by the corporation having something called passive investment income in excess of 25% of gross receipts for 3 years. Now, this passive investment income rule only applies to S corps that have earnings and profits. Now, what type of an S corp would have earnings and profits? Because an S corp that starts out as an S corp and continues as an S corp does not have earnings and profits. Well, the only kind of S corp that has earnings and profits is an S corp that was, prior to becoming an S corp, a C corp with earnings and profits at the time of its conversion to an S corp. So this passive investment income rule only applies to S corps that were prior C corps, and at the time of that election, the C corp had earnings and profits. Now, if you do involuntarily terminate your S corp status, essentially what you have to do in that year of termination is you have once you have your date of termination, you essentially have a short year. The dates prior to the termination and up to, and we'll talk about this more, but it's usually January 1st. Let's say you terminated March 1st. Well, you're going to take and you're going to have a short year S corp tax return that you're going to have to file for January 1st through February 28th. And then starting March 1st, you're going to have a short year C corp return that you're going to have to file. So that's what they're talking about as far as effective date. Now, most, I'm not sure where this is in here. I think it's under elections. Again, like partnerships, most elections as far as accounting methods and tax years and all that are made by the S corp, not individuals, shareholders. And you don't you don't have all this, you know, you remember those 3 rules in figuring out the tax year, the least aggregate deferral and all that junk? Well, you don't have that for S corps. For the most part, S corps must file calendar year tax returns unless they can show that, prove to the IRS and get their permission that another tax year end would be more sufficient. And there's some other different rules that we'll talk about here in a minute. We're just going to do half the chapter today and the rest next time, tomorrow. If you do have a short tax year, you have a couple of different methods, the daily method or the specific ID method. And then you have your tax return due dates for S corp and C corp that you have to deal with. Note here, if you either voluntarily or involuntarily terminate your S corp status, you can re-elect to become an S corp, but you cannot do so. You cannot actually be an S corp again until the beginning of the 5th year after the year of termination. Now, again, there's an exception here. You might be able to convince the IRS that to become an S corp sooner, and so you can get their consent. But there's some restrictions on that, and the restrictions are if the corporation is now owned more than 50% by shareholders who were not owners at the time of termination. So essentially you've got whole new owners here, or at least a big portion of new owners. Or the termination was not reasonably within the control of the corporation or shareholders with a substantial interest in the corporation and was not part of a planned termination by the corporation or shareholders. I'm not sure if I have an example of that, but hopefully you get the gist there. All right. Let's talk about operating issues. And again, this is kind of where some of the things I just mentioned, talked about. This is just a continuation. And so accounting periods and methods are elected at the entity level. If you were a prior C Corp, any methods that you elected as a C Corp carry over to the S Corp. And an S Corp can choose as their method of accounting either the cash method, accrual method, or if they have inventory, they're required to account for that inventory using the accrual method. Everything else they can account for using the cash method. So that would be a hybrid method. And again, S Corps must use a calendar year end unless they can prove to the IRS that an alternative year end or a natural business year end would be a more appropriate year end. Income and loss allocations. Now here, this is different than with partnerships Recall that partnerships, you can specifically allocate certain items of income, loss, et cetera, to specific partners. The one big restriction is that there has to be a good reason for doing so other than the avoidance of taxes. That's that substantial economic effect rule. Here you can't make special allocations to particular S Corp shareholders. The profit and losses of the S Corp have to be allocated on a pro rata basis based upon the percentage of ownership of a particular shareholder for each day owned during the year. And then, if you sell shares, they have some rules about that, but I don't think we'll get into that, so I wouldn't worry about it. Although, here's an example, so I guess we will worry about it. Assume CCS was formed as a calendar year S Corp with Nicole, Sarah, and Chance as equal 1/3 shareholders. On June 1st, Chance sold his shares to Nicole. CCS reported business income for 2015 as follows. So for the first 165 days up to the sale, they have $100,000. And then from June 14th through the 31st of December, 265. And so how much of this 2015 income is allocated to each shareholder if CCS uses the daily method of allocating income? Nicole's is 188,333. Sarah's is 121,667. And Chance's is $55,000. Now, how did they get to that? Not really important. I don't think we'll have a problem on that, so I wouldn't worry about it. At least I hope not. And so, you have your S Corp, just like with a partnership, you've got your items of income, loss, et cetera. You've got your ordinary business income, and then you have your separately stated items. For the most part, very similar to these separately stated items are very similar to partnership. The only difference there as far as separately stated items relates to guaranteed payments. There is no such thing in an S Corp. And let's see what else. Seems like there's some other stuff. A couple of other things. Yeah, do not have guaranteed payment. The other thing is S Corps do not report self-employment income. So those are the two main things. And so if you look at Exhibit 22-1, those are some common separately stated items, and they're very similar to what you saw in partnerships. And again, you've got your Form 1120S that you file, and let's see here. Also, your Schedule K1. Somewhere they talk about the due date. I'm sure it's March 15th also, just like, or corporations, C Corps. All right, we're going to briefly talk about shareholders' basis, and that's about where we're going to stop on this. And then we'll pick it up tomorrow at probably loss limitations and all that stuff. Don't want to spend a lot of time on that, but some. All right, so the initial basis of a shareholder in an exchange of property that's transferred to the corporation by a new shareholder is the tax basis of the property transferred. So it's just like a C Corp. Less any liabilities assumed by the corporation on the property contributed. Now, any gains recognized increase the shareholders' basis, and would be reduced by the fair market value of any property received other than stock. So basically the whole boot situation. So anyway, the formula is very similar to, if not exactly the same as C Corp. You've got your tax basis in the property that you transfer. Any liabilities assumed by the corporation, reduce that basis. If you recognize a gain because of boot received, you increase the initial basis by that amount of gain, and then you reduce basis by the fair market value of any property received other than stock, the boot property received. So that's all that's saying. Now, what happens if you purchase existing shares of stock? Well, your initial basis is simply going to be your purchase price. And so, just like with partnerships, you're going to have these annual basis adjustments. You're going to have increases for contributions, additional contributions made to the corporation. You're going to have increases for the shareholders' pro rata share of income or gain items, including tax-exempt income. You're going to decrease basis for distributions made to a shareholder, the shareholder's share of non-deductible expenses, as well as the shareholder's share of expense and or loss items. Note here that basis can never be less than 0. That makes sense, right? And so assume that Nicole's beginning of year basis in CCS is $115,000. This year she allocated her allocated share of S Corp items are $80,000 business income, $2,000 interest income, $1,000 dividends, $400 tax exempt interest income. What is Nicole's basis? Well, you're just going to add all those up, right? and add that to the initial basis, and so her tax basis at the end of 2015 is the sum of those amounts, $198,000. Easy enough. All right, I think we're going to end this here, and tomorrow we'll pick up with loss limitations and talk about tax basis limitation and all that junk, and what happens when you have this losses in excess of your basis, and how you can, what you can do to recover some of that. So anyway, we'll discuss that tomorrow.